prepare as if, right? Make sure that your risk tolerance drives your decision making and not the opposite way around.
We're going to pick one today that comes from Fortunes and Frictions, the blog by Reuben Miller, a chartered financial analyst.
That's a good one.
And it is titled, "Is It Time to Sell Stocks?" A lot of people have this question right now. They were asking it early in the year. They're asking it now. I find that, probably almost 365 days a year, people are asking themselves, should I sell my stocks right now? Or should I buy my stocks right now? And so I think this offers a lot of good insight. And it's based around a 1,000-year-old Japanese mochi store? Mochi.
We both had to look that one up.
I had to look that up. These Midwestern boys, we don't get down with a lot of mochi, but it does provide some really good insight.
But now we're interested, right? We want to try this. This Japanese mochi store's been around 1,000 years. They got to be doing something right.
Yeah, and it provides a lot of good insight into not just the Japanese culture, but how we can apply some of the principles that have kept Japanese businesses around for hundreds and hundreds, even over 1,000 years in business, and how you can do and apply some of those same principles to your finances to make sure that those assets last throughout your entire retirement.
Well, the article starts off by talking about human emotions. And in this year in particular, and I think Casey probably make a good point, is people are constantly asking or thinking, what should I be doing? Well, the market's, reverse course a little bit since June. There's some gains there. Should I take some risk off the table? Should I sell some stocks? Should I raise some capital gains here? And really what the article's getting at is, you need to focus not so much on those human emotions. It's very normal to think like, hey, I should be doing something, but what you should be doing is nothing at all.
Yeah,
right?
Yeah, and I do want to point out, this is one of the things we like to do with these articles, is kind of share some areas that we go, is that really the way it is? Global stocks are up almost 10% since mid-June, says the article. Bond funds have also recovered, and investors are finally getting some welcome sighs of relief. I don't argue that investors are getting a sigh of relief right now over the last couple of months. However, I'm not quite sure bond funds have recovered. I don't know which bond fund Reuben's pointing out.
Definitely not long-term. Long-term government treasuries have not recovered. They're still down 24%.
Let's take the S&P 500 is still down 10% year to date. The aggregate bond index, AGG, still down 10% year to date. Now, from the lows, S&P 500 up about 17% currently as we record this on August 16th, and this article was released on August 4th. The aggregate bond index up almost 3%.
3.3,
right?
Something like that.
So it doesn't really seem like anything's really recovered at this point.
Yeah, the 60-40 portfolio is still down probably 10% at this point.
Had a nice little run here.
Yes.
And I think it does make sense. You go, we had a little run, and I've heard some news and some talking heads going, wow, the market's headed for another big drop here in the not too distant future. And I don't have a crystal ball. I don't know if the market's going to go up or down over the next couple of months. I love to make my little predictions myself, and I'm a little pessimistic, currently.
Do some famous names, Kathy Wood saying 50% down. We've got Jamie Dimon talking about a big downturn. Some of these famous folks, and that leaks its way back to us, right? We've got clients that go, hey, what do you think about Kathy Wood talking about another 50% drop from where we're at, right? Yeah. So people are talking about this. There's people, giving their crystal ball recommendations, and it can be a little bit dangerous.
Hey, I know you're tuning in right now because you're all about leveling up, and we have an awesome way for you to do that, a free resource that goes out every single Friday, an email that hits your inbox. It's called Weekend Reading for Retirees. We distill down hundreds of articles to 4 articles on trending topics that can help you make better decisions about your retirement and your finances, both financial and non-financial. Not only will you get those articles with summaries and takeaways for myself, but you'll also receive special invitations to events, book giveaways, white papers, and so much more. Click the link in the description to sign up today. And I think this works on both sides of the market. Whether the market's down or the market's up, we're still asking a market timing question, right? Market's down, should I allocate more money to equities? Market's up, should I take some chips off the table? We're constantly taking a look at this from really a gambling perspective. So I think the article is making a pretty good point that you might be wondering, should I cash in a little bit and take some chips off the table? Well, that's kind of a gambling analogy that's being proposed there, which is what we're doing if we are guessing what the market's going to do next. We go, hey, market's down 20%. I think this is a good time to put some more money to work. Well, what if it goes down to 40%? Maybe 20% wasn't the best timing, right? And so we need to have a methodology, whether we're allocating dollars to the market or not. I think this has the most application to a retiree that's no longer developing new cash to put to work in the market than it does for a younger individual. I see a lot of younger individuals that, hey, I shouldn't say a lot, but most younger individuals have a small amount of money they're allocating to the market on a periodic basis out of their paycheck. That's just a systematic, no decision needs to be made. It's just a systematic process. It is a strategy. And then you have your unusual younger individuals that might hit a home run every once in a while. They've got an extra 50 grand, 100 grand, 200 grand
stimulus
that they want to do something.
YOLO into crypto.
Yeah, but they want to do something. They go, should I put this money to work? That might be someone that should be asking that question.
Short term.
Is now the good time to be putting this money to work in the market?
But to your other point, the long-term investor that has built a strategy for the long term that's now trying to make short-term trading decisions, like, wait a minute, we can learn some lessons from this Japanese.
Well, you can also learn some lessons about how you got to where you're at today, right? You're in retirement. You've been saving for 40 years. How did you get to where you're at today? You bought some things in your 401k. Maybe you had a basic allocation of 60-40 or 80-20. You just picked an allocation. Maybe you picked a target date fund in your 401k, and then you just dollar cost averaged into the market. You didn't even worry about, well, the market's down a little bit more. Should I take some chips off the table or put some more money in? You didn't ask those types of questions. You just continued to follow a strategy and you stuck with it. Now you're in retirement and you're going, well, what should I do? Should I make some changes? I think you need to go back and look at what you did that got you here. You followed a strategy. Now, the strategy needs to be different today than it was when you were 20, 30, or 40. But if you have a strategy, you should still be following that strategy and leading yourself down a successful path.
And as the article points out, the best investors don't wonder, they don't even make decisions. And that's what you're saying. If you've got a rock solid plan, you just follow the plan. You don't have to make decisions at a breakneck speed or when things change rapidly. Much like you want to say her name?
Naomi Hasegawa.
Yes. Operator of Ichiwa in Kyoto, Japan. Her family started the business selling rice cakes called mochi years ago, more precisely, 1,000 years ago.
1,000 years ago.
And they don't do anything.
Amazing. This is very unique to Japanese culture. We've got 33,000 companies in Japan. There are over 33,000 companies in Japan that are over 100 years old. That's 40% of all global companies in that age bracket.
40% of them are in Japan.
140 companies there are over 500 years old. So why is that? I mean, what is unique in the Japanese culture that has led to so much longevity in so many different companies or businesses? And there's a few different insights into why that might be. Their number one priority is carrying on. Each generation is like a runner in a relay race. What's important is just passing that baton.
Right.
It's
survival.
The longevity of the portfolio. They are investing much like a university trust fund might, right? They need that to last into perpetuity. It has to last forever. So systematic decisions have to be made that aren't even being made, right? It's just systematic. It's just natural. It's focus, and it's all around one goal. How do we get this to last into perpetuity? How do we make sure this business is around forever? And Naomi says, to survive for a millennium, Miss Hasegawa said, a business cannot just chase profits. It has to have a higher purpose.
Well, hey, that follows right in line with our thinking, right? Your financial plan needs to drive more purpose and meaning to your life as well. You got to have that.
And that's what the decisions should be made around. And think about some of the decisions that you might be pondering today. what's the real impact going to be in your life if today, for instance, you took some chips off the table? Maybe take 5, 10, 15% of your portfolio off the table, set it in cash. What impact does that have? What positive impact, I should say, does that have in your life? Does it bring more meaning and purpose to your life? Probably not. It probably does quite the opposite, because you're absorbed now in thinking about taking some of those chips off the table. Is this the right time? I'm setting it aside. And then what's that create down the road? Now it's created 30, 60, 90 days, 3 years from now. When do I get back in? You've made one decision to get out. Now you've got to make another decision to get back in. I would argue that for especially the majority of the families that we work with, if they're thinking about those types of things, it's a distraction from why they're here in the first place.
Yeah, the article references, your big portfolio. What we do as humans is we create mental accounting, right? We've got the big portfolio, and then you've just created this small sidecar. So in your words, you took some cash off the table. So you built this small sidecar account. Now, if the market continues to go up, you're thrilled. You can make the case for why you're thrilled, right? Your bigger portfolio is still going to have gains. If the market goes down, well, you're going to make the case that, hey, well, at least I did something. It's that mental accounting that is going to try and make a positive out of that decision, and then you're just creating this momentum and this rhythm for you to keep doing this the rest of your life and not focusing on the mission, right? You need the portfolio to know what the mission is.
Yeah, and doing some of those things might be likened to what Naomi could have done in their mochi business. And that would have been during COVID, right? During COVID, a lot of businesses, and what she could have done in that business was make a pivot.
Yeah.
Everything around COVID in the business world was all about pivoting, pivot.
Start to deliver, start to add new product lines. And
or add Uber Eats, right? Uber Eats wanted to set up deliveries. And it's like, no, we're not going to do any of those things, because we're focused on doing one thing very well, doing one thing and doing that one thing very well. If you're going to head down this mental accounting road, as you touched on, Marshall, where we're going to have this big portfolio, we're going to shave a little bit off here, and then we're going to feel good about no matter what happens next. We're just finding a way to rationalize feeling good about an outcome at the end of the day. And portfolios are not tools to help us rationalize the trades we want to make. Portfolios are tools to live better lives and should pursue the highest probability of allowing us to actually do that in the first place. And I want to say, it doesn't mean that we shouldn't do something, because I think there is a lot of power mentally and behaviorally in actually taking some action. This may not be the right action, but it may be worth your own mental stability to take an action. Taking a little bit of your portfolio and allocating cash or vice versa, probably not going to have much of any impact on the success of your financial life or meeting your financial goals over the long run. But it may still weigh on you in the way that I need to do something. And Dan Egan, who is a past podcast guest, he's the behavioral expert, finance expert. He's over at Betterment, behavioral finance and investing at Betterment. And we discussed in depth one of his articles in a past weekend reading. I believe it was episode number 178 of our weekend reading podcast, that we talked about one of his blogs that was titled Sacrifice Throws. And the emotional, behavioral, mental benefit of actually doing something. Maybe it's not liquidating and trying to time the market, but it may make sense to do some tax loss harvesting or rebalancing, or maybe you have some cash on the sidelines and getting those things to work. Maybe exiting out of some high-cost mutual funds that you had that had large capital gains that, well, now those gains are maybe not there anymore, and we can reallocate to lower-cost funds. I mean, taking some action, I think, has really big benefits behaviorally or emotionally or mentally. I think financially, a lot of those moves that you tend to make or tend to get recommended during times of volatility have a minimal effect on the long-term success of your strategy, if you have a strategy.
Yeah. And what I wanted to go back there too is something you said about risk. If you were in the accumulation phase of life and now you're in retirement, you're focusing more on income and distribution, and you haven't changed your mindset or you haven't changed your investment strategy, I think the best thing to do here is, when I have a client ask me if I believe Kathy Wood, do I think the market's going to drop 50% from here, is to play that what if game. Like, well, what if it did? Let's take your balances down. Let's see if your strategy would still work. prepare as if, right? Make sure that your risk tolerance drives your decision making and not the opposite way around. So really understanding, is your portfolio aligned for where you're at in this stage of life, understanding the risk that you're taking, and then running those stress tests, running those scenarios to see if we could handle a 30% drawdown, 40%, 50%. What does that mean to you, and will this change your life?
And my favorite quote to that point is, as the manager of your portfolio, you should do one thing really well, and it's to be a methodical implementer of a pre-designed plan. A pre-designed plan, not one that you're just coming up with right now, but a pre-designed plan. And that's what we're doing when we're building a decision-making framework for the families we're working with called the Life Framework, right? It's liquidity, income, flexibility, estate, tax planning, healthcare planning. Let's cover all of our different bases.
Yeah.
Let's make sure that we're following this methodology. So when times like this come, we go, hey, market's down 20%. And you go, okay, well, we had this risk tolerance for your overall portfolio. Is your risk number still in line with that? Well, maybe it's not. Maybe we do need to do a little rebalancing or shuffling of things based on that overall framework in that plan.
Methodically.
Methodically.
Can we put that on our business card? Methodical implementer. I love it.
Yeah.
Let's make T-shirts.
Well, and I think it is true right now that one of the things that's difficult to do is rebalance, right? If we have both bond markets and equity markets down about the same percentage, we're not really, we're still holding on to the same 64 portfolio
so
that
you
we started
may not need
with.
to rebalance.
You may not need to rebalance today because you still have the same balance. And he says, eventually there will be a time when the imbalance happens again, as it has hundreds of times, historically. There will be another opportunity where you see bonds and equities diverge, and you'll be imbalanced. You'll be able to, rebalance and take advantage of those opportunities. But I would say I don't want to bet on that for the next 5-10 years. And we could be in a rising interest rate environment for an extended period of time. What's that going to do to the bond market? Are these returns going to come more in line with one another, especially after we factor in all the other things going on in the global economy? You might want to think about considering some alternative asset classes to traditional bonds or equities. I had a family that I've been working with for several years now, and they came in. We're looking at where the market is, and they're both asking this question: should we be putting more money in the market? They said the market's down in value. The market was down around 20% at the time, and they said, I feel like it'd be a good time for us to shift some of our dollars into the market. And I said, well, first, let's go back to the framework, right? So we went back up and we looked at their framework.
Methodically.
I said, let's look at how much we have in our liquidity bucket or income bucket or flexibility bucket or estate bucket. And when we look at all those different buckets, this is where you're actually at from a risk standpoint. Is this still in line with the amount of risk that you want to be taking? And they go, yeah, I guess I don't really want to put any more money at risk. I'm pretty comfortable with the balance that we have. But I think it would make sense to take on a little bit more. We'd be comfortable taking on a little bit more risk than we have historically. And they're able to do that because instead of having bonds in their portfolio, we have fixed indexed accounts and fixed accounts in there that are with insurance companies that are making bond-like returns but haven't had any of the downside.
Drawdowns.
So they are actually a little imbalanced, right? So their balance is a little different because they actually did not take any losses in the fixed income portion of their portfolio because they didn't own bonds. They owned fixed annuities and fixed index annuities. And so we took all the free withdrawals they had available from those accounts that were not down in value. We moved those dollars over to equities and maintained the same risk profile and the same overall strategy. And they were able to do that because they weren't just working with a CFA that was allocating them the stocks and bonds.
Right. And they understood what their required rate of return was. They knew that they were on track, regardless of whether they took additional risk or they stayed where they were. Then that gives you a place of comfort where you can make that decision.
It wasn't just, why don't we put $500,000 in the market?
I feel like I should do something.
I feel like we should just put $500,000 in equities. I mean, that was kind of how the conversation started. I feel like we should put this large allocation into equities. When we go back and look at things, they go, you know what? I guess following where we want to be in life and actually accomplishing everything we want to do. We don't need to take any risk. And in taking that risk, said, all right, well, let's say that we take $500,000 and allocate it to equities and it turns into $1 million over the next 12 months, 18 months, 2 years. What's that going to change in your life? Are you going to go out and get a new car? I mean, this is someone that drives a used car and gets a new used car maybe every 5 to 7 years, wearing the same watch that he's had for 30 or 40 years. They're not going to spend any more money. It's not going to have it is an exercise in futility.
It's a distraction
for us to have this conversation. It's a total distraction from what we put the plan together for in the first place. And we just need that reminder, someone to go back, talk about why we built the plan, where we're at from an asset standpoint, where we're at from a risk standpoint, a purpose standpoint, and make the decision from there, not just make it willy-nilly because we saw somebody on the news say, oh man, the market's going to pop 30% over the next 12 months. Or Jeremy Siegel, says, if I put money in the market right now, 12 months from now, I'm going to be really happy. Let's not make the decision based on what our neighbor says or a talking head says.
Yeah, I love the quote here towards the end, and I might be skipping over something that you wanted to talk about, but don't let your boredom overwhelm your discipline. Least you'll end up being either a crappy long-term investor or a crappy short-term trader.
I just leave it at that.
I love it.